Hello, good afternoon. This is Matt Kemp with SPIA, and it is December 3rd. This is the Boeing retirement and pension and retirement webinar. You are all very fortunate to be with me virtually today instead of in person. I am under the weather, so even if we could have been in person, it probably wouldn't have happened today. So you'll have to excuse me if I pause, if I have a coughing attack or something like that. We're supposed to have about 300 people, as we've got less than that online right now. So we'll give it a couple minutes before we start. I think most of the reason for the attendance, the high attendance, is the pending layoffs that were announced, and the second round apparently is going to managers tomorrow. So we can get through some pleasantries first, and then hopefully more folks will have a chance to join. If someone could do me a favor though, and in the questions section, if you could let me know if you hear me. Okay, just to make sure I'm being heard. Okay, I am being heard. Yeah, so the pleasantries. So my name is Matt Kempf. I'm on staff with SPIA. I'm a certified financial planner and a certified employee benefit specialist. So I have some disclosures to get through. That's my full name, my full title. That's my full contact information. That is my email address is the best way to get in touch with me. I have an office down in Tukwila on 52nd Avenue South near South Center, and that is my landline. Feel free to call me or email me with questions after the session. I'm a salaried employee of the union, so your dues pay my salary, so thank you. I'm grateful for that. I don't take clients, so no part of my compensation is based on financial planning fees or referral relationships or anything like that. And also SPIA policies prohibit referrals to any person or any company for any reason. And I really mean that when I say it. Often people say, yeah, wink, wink, nod, nod, but can you give me a name? And, no, we really can't. As you can imagine, there are almost an unlimited amount of financial advisors who want to get referrals from Boeing engineers and Boeing techs and Boeing pilots. And so we have just said a blanket no. So no referrals to anyone. Highly summarized presentation. This is the key phrase is general financial education materials. This is not financial planning. This is not advice. I am educating you on your options, and you will make a hopefully well-informed decision when it comes time to retire. And of course, in the event that there's a conflict between what I say and what the plans are required to pay, the terms of the plan will control, unless of course they're in violation of the contract, and then we'll have a contractual way to resolve that. So what we're going to do is pretty much the same as in the past. We're going to go through the money and the medical, and then we have a new section for those that are considering layoff and the timing, and some kind of what things to watch out for, what kind of things what mistakes not to make, what kind of pitfalls that you don't want to fall into. And with this many people, I think it really will work best if we go through the entire presentation and then address questions. I do not have any tennis commitments after this because I'm sick, so I can stay as long as you would like and hopefully answer all of your questions. But please keep in mind, if you have a question about the pension, it might make sense to wait until after we've gone through the pension section, because we may just answer your question during the pension section. So without further ado, let's kind of get into it. So the pension is called the Boeing Company Employee Retirement Plan, BSERP. Oh, sorry. This presentation is being recorded. You can find it online, hopefully tomorrow, at spia.org. Oh my gosh, I can't type, can I? And then go to medical and retirement and video seminars. And here it'll be a featured video. There's the last one that was recorded virtually in September. There's the Wichita contract offer, and here's the open enrollment that's now closed. So for the Puget Sound Prof and Tech, but this is where it will be hosted, and you can scroll through and see lots of presentations we have recorded. I understand that there are some issues using this software, but it's really nice to have all of these prior sessions, and so we're gonna have to think about what to do. One of the least watched, probably one of the best ones though, is, why do we have the contract that we have right now in the Puget Sound? And that's this proposed contract offer. There's a lot of things behind the scenes that people don't understand, and that's why this offer is in place right now. But this will be posted online here tomorrow, hopefully before noon. I also did email out the handouts not too long ago, so maybe an hour ago. So if you were one of the late registration folks, feel free to send me an email requesting the PDFs of the presentation. Otherwise, check your junk email if you don't think you have it. So the BSERP, the Boeing Company Employee Retirement Plan, it's got a flow chart and there's multiple formulas that apply. There's a standard benefit that most people know. It's the $100 per year of service, $100 a month per year of service. There's an age-based reduction that is in whole complete months of age. So if it's in 1/12 or 2/12 or 6/12. So if you happen to be 59 and a half years old, that's the same as 59 and 6/12 old. So then it would be 6/12 or 1/2 of a 2% reduction, which would make it a 1% reduction. So that the standard benefit is calculated for all of the eligible participants. And then there's also an alternate that is applied to everyone. It has two different components to it, the core and the excess. And notice they have different age-based penalties, 2 and 5 for the core and the excess. And you would add those together times your service, and then you would get the greater of the two, the greater of the alternate or the standard. So you can kind of consider the standard benefit like a minimum. So at least you'll get $100 per month per year of service. You might get more if this alternate ends up, if the alternate benefit ends up producing a larger monthly benefit for you. There's also an old alternate formula that was in place if you were a Boeing employee on January 1, 1993, and that has yet again a different age-based penalty. And if that one produces more than the other alternate, then that's the one that would apply. So you get the greater of the two or the greater of the three formulas. You would get these preferential penalties, the 3, the 2, 5, and the 2, if you leave the company retirement eligible. That means after age 55. I'm in conversations with a gentleman right now who will be 54 this February, and due to his family life, he's considering quitting. And he's got more than 20, 25 years of service with Boeing. He was last hired before 2007. And if you quit, if you quit before 55, you don't get these good penalties. Instead, you get the bad penalties. And the penalties for someone who just used to be a Boeing employee is called a former vested benefit. The penalties all change from what you see on the screen. So the 3, the 2, the 5, and the 2 to 6%. And it's for each year under age 65 instead of age 60. So it's a significantly larger pension penalty. And this individual, if he quits before 55, would also then lose retiree medical, which we'll get to towards the end of the presentation. So if you have any control of the matter, you really do not want to quit before 55. Layoffs, we're in a layoff cycle right now. So layoffs include what's called a 6-year bridge. And so that 6 years can bridge you to age 55. So if you're laid off at age 49, you'd have to hold your breath for 6 years and find some other way to get money and retiree medical or normal medical. But then when you turn 55, you'd be eligible for this as if you were still an employee. So it's a 6-year bridge to get you the good penalties, and a 6-year bridge to get you to retiree medical eligibility. If you are laid off at 48 or 48 and a half or 48 and 3/4, that 6-year bridge will not get you to 55. So it's actually to the day. And so worst case scenario, you're laid off at 48 and 11 months old. That would really stink. But if you're laid off at 49 or older, as long as you maintain layoff status, which means you don't say no to a equivalent job offer, then as long as you maintain your layoff status, then you are eligible at age 55 to get the good penalties. The standard conversion factor going back in time, this pension's been around for a long time. It has been locked at $100 per month for the duration of this contract and the prior contract. but there's no reason why I can't go higher. As you may or may not know, the IAMs just went from 95 to 105. So they increased their conversion factor. We could do the same next negotiation if it's important. The plan keeps track of time two different ways. One, the vesting service is to determine your legal entitlement to a benefit. If you have a vested benefit under the current pension laws, Boeing has to go bankrupt trying to get you your vested accrued benefit at normal retirement age. And normal retirement age for this pension is age 65. Technically, your age 65 payable benefit can't even be negotiated away under the current federal rules. But vesting just determines your entitlement to something. What determines how big that something is a credited service and the conversion factors in your final average earnings. So pension credited service used to accrue every single pay week until December 31st, 2018. And then you stopped accruing pension credited service. And so some people will, it's less common now, but really, really common, 5 years ago in 2019 or 2020, people say, hey, I've got 32 years of Boeing service. How come I only have 30 years in the pension? Well, it's because you stopped accruing back in 2018. But everything else with the pension continues to go. So your final average earnings, which we'll learn about in a second, your final average earnings will grow your old benefit. The Social Security covered compensation number will continue to grow. It's just no more credited service. So the alternate that applies to everyone is a mathematical formula based on final average earnings. And I've got an example coming up. Your final average earnings is your highest consecutive monthly base salary over any period of 60 consecutive months out of your last 120. For the vast, vast, vast majority of you, it's going to be your average base salary on the first of each month where you do 1 hour of service for the company. So it's your annual salary divided by 12 to make a monthly base salary. And it's going to be your last 5 years, average salary last 5 years. So you don't get to work more. So overtime does not increase your final average earnings. Shift differential doesn't. Cost of living doesn't. Also, the EUM extra funds don't. However, the EIPs and lump sum awards made before your termination of employment are included if it was paid within 60 months of your benefit commencement date. And it's literally the sum of your EIPs and lump sum awards in the 60 months before your benefit commencement date divided by 60. So it's kind of like the equivalent of an average monthly salary plus an average monthly equivalent of an EIP and lump sum award. The EIPs have been paying out fairly well over the past 20 years. 1 year was a zero. That was 2019. So 2019 performance year paid and not paid in 2020. And so if you work and receive the EIP as an active employee, let's pretend there's a 5% EIP paid in 2025 based on 2024 performance, which might happen, might not happen, who knows. But if you wait and receive that, then a 5% would be added and the 0% would be dropped off. So that would increase your final average earnings upwards of, I don't know, $70, $80 a month for the rest of your life. There's also one unique twist that's going to happen in February of 2026. I'm going to take this off so you can see my notes. Yeah. So in 2021, the EIP used to be paid every single February. It was always the second paycheck in February. And then when COVID happened and there was a zero paid in 2020, when it started back up again, it was paid in the first March paycheck. So this 2021 was in March, 2022 was in March, 2023 was in March, but now 2024 was back to February. If 2025 goes back to February and 2026 goes back to February, there is 1 month where you would actually have 6 EIPs paid in the 60 months prior to your benefit commencement date. And I think there will be quite a few people who will do the math if there is a decent EIP paid in 2025 and in 2026. And if both of those are both paid in February also, that a lot of people will terminate their employment the day after the February 2026 paid EIP and then commence their pension March 1st. And they would get 6 EIPs paid in the 60 months prior to their benefit commencement date rather than 5. So there's a special kind of unicorn star alignment going to occur in late February, early March 2026. The covered compensation reduces, so I'll go back to the formula. So it's the core plus the excess times years of service. The core is 1.025% times your monthly final average earnings, which includes that EIP thing we just discussed, times the first early reduction factor of 2% per year for every year under age 60. The excess is 0.45% times the net of your monthly final average earnings minus covered compensation times the second reduction of 5%. Well, covered compensation for this year, for 2024, is 82.19. I haven't calculated 2025 yet, but I'll do it before the next session. But covered compensation, when you're working, you pay taxes. And there's two kinds of taxes that we're primarily talking about here. Federal income taxes, and you do withholding for that, and you settle up when you file your taxes. But you also pay FICA, and FICA is for Social Security and Medicare. And it's 7.65% on the first, well, the 7.65% is 1.45% for Medicare and 6.2% for Social Security. And the 6.2% is only taken on your first $168,600 this year. So at some point, if you make more than that, let's pretend your base salary is $200,000, maybe October-ish, you would stop paying 6.2% because you had been paid so far $168,600. So that's called the wage-based threshold, is when you stop paying Social Security tax. And a 35-year average of that wage-based threshold, the pension plan considers to be covered by Social Security, so it's covered compensation. And so a 35-year average of that number is 82.19. And here's the example: someone with the final average earnings, including the EIPs and stuff, of 13,000, age 60, so no age-based penalty if they terminate, right away and then commence right away. 30 years of pension credited service. The 1.025% times the $13,000 times 1.0 because it's not being reduced. If this person were 59.5, it'd be times 0.99, right? That's 6/12 of 2%, or for the core, yeah. And the excess, 0.45% times the 13,000 final average earnings minus the covered compensation, 82.19, again times 1 because the person is 60 years old, is 21.52. You'd add them together, 154.77 times 30 years of service is 46.81 a month. So this person, the standard benefit is $100 per month per year of service. This person is getting $154 per month per year of service. So yeah, the standard is kind of like a minimum benefit in that manner. The old alternate formula applies if you were a Boeing employee on January 1, 1993. You have to be a heritage Boeing employee, not McDonnell Douglas. And it uses the same definition of final average earnings, the same definition of BSERP credited service, which stopped accruing back in 2018, and your estimated primary Social Security retirement benefit. Now, this is a new Social Security thing, and it's your monthly final average earnings times 1.5% minus an estimated Social Security benefit times 1.25% times years of service, and then reduced differently, 3% per year. For every year under age 60 if you're eligible because you left after 55. This estimated primary Social Security retirement benefit is the Social Security benefits that one would have if they had the salary that you had on your commencement date, and if every single January 1 prior for the past 35 years they received a salary increase that is the United States non-agricultural wage index plus 2%. So you have to solve backwards. And yeah, that's the estimate, and that's where that comes from. Most likely, if you're eligible for the old alternate, there's less and less people that are eligible for this because a lot of them left over the past 10 years or so. But most likely, this will produce more money than the normal alternate would, which is a good thing. So how you settle from the plan, they are called settlement options. And it's monthly annuities. Some people see the word annuity and think it's an annuity from a life insurance company, but it's not. It is just a monthly check from the pension plan. The formulas that we went through produce one monthly amount for your single life. It's called a single life annuity, and it pays as long as you continue to live. There are options, and thankfully there are options that can also give your surviving spouse or domestic partner a life benefit. So there's single life, and then there's a single life with a guaranteed minimum 10-year period certain, so they'll pay at least 10 years if you choose that option. There's, if you're married or in a domestic partnership, a 50, 75, and 100% option. And each of these annuity options, the single with 10, 50, 75, and 100, could be had with or without this thing called accelerated income if you're under 62 and 2 months old. And lastly is the lump sum. I imagine there are some folks here that are curious about the lump sum because the lump sum conversion factors changed based on segment rates from November the year prior. But the lump sum is a lump sum of money now instead of monthly pension checks for the rest of your life. And two things have to happen to convert monthly pension checks for the rest of your life into a lump sum of money now. I think that we all agree, it kind of makes sense, that money given to you now is worth more than money given to you 20 and 30 years from now, because you can invest the money between now and then. And so the pension plan uses IRS published interest rates. They're called segment rates for segments of investment risk at time. So 3 different rates for 3 different segments of time for the rest of your life to discount those future pension checks back to today. And then it's also adjusted for mortality. Quite literally, half of you will live longer than average and half of you will live not longer than average, but altogether you're going to live average. And so it uses the unisex mortality tables and the segment rates in place from November the year prior. And at that point, it's just more cash. You can take the whole thing as cash and you can pay a whole bunch of taxes on it if you want to, or you can roll it into your pre-tax 401k. If you do that, it's ruled in the way that you have instructed the 401k to allocate new paycheck contributions. So if right now, maybe I'm not giving you advice, but I'm saying if, let's pretend, half of your stuff was in stable value and half was in S&P 500, and if you think the economy is going to do good, so you say everything new goes into S&P 500, and if you were to take this lump sum, roll it to your 401k, the whole thing would go to S&P 500 index, because that's where you told the 401k plan to allocate new paycheck contributions. Once your money is in the 401k, it's just more money in the 401k. That's all it is. So you'll have higher required minimum distributions, which we'll talk about later. If you were to take it into your 401k, or you can go directly to an IRA, you could roll it to an IRA outside of Boeing, then it's just more money in an IRA. And yeah, you can convert the IRA to Roth. You can do all kinds of stuff with money in an IRA. So it's just more money. That's all it is. So there's some pretty obvious decisions. I do end up talking with the people who are dying. And if you are single and you are dying, let's pretend you're in hospice and you've got less than 6 months to live. If you die before you commence your pension, the pension plan just absorbs that money and holds it, and then it pays the people that live too long, the yin to the yang, the other side of the teeter-totter. So if you're sick and dying, you want to commence your pension right away. That way you can give it to anybody you want, and if you choose a lump sum, it's more value than your 10-year period certain would have been as a monthly annuity, and you can leave it to a charity or your nieces or nephews, whoever you put as your 401k beneficiary. I had an individual leaving for Boeing for a higher paying job somewhere else. He was over 55 with more than 10 years of service, and for him, he had a choice. He could take his pension as a monthly annuity and pay his highest marginal tax rates on the pension checks that he gets every month on top of his higher salary at the next job, or he could take the value of his pension, roll it into his 401k pre-tax, and let it continue to compound tax deferred while he finished out his second career. So for him, it was obvious. And if it isn't obvious, it's some kind of shade of gray. If it's not obvious, super obvious, then there's some kind of risk transfer that occurs, whether it be longevity risk, living too long, or investment risk, inflation risk, or even legislative risk. Longevity risk, if you live too long and you've chosen a monthly annuity from Boeing, that's Boeing's problem, not your problem. When you take the value of your 401k, the value of your pension, put it into your 401k, now that problem is yours. So you've taken on that risk. You would also take on investment risk if you did that, because you have to invest the money rather than having Boeing pension plan money managers professionally manage that money in the pension plan. So it's all about transfer risks. This is an oversimplified, outdated example that describes how $2,000 a month would have turned into about $400,000 back in 2017. So it's oversimplified just to prove a point. It's outdated also just to prove a point. So you don't think about the numbers, but you think about the process. So this example uses annual pension checks. So $2,000 a month is $24,000 a year. The IRS has those interest rates. Remember, there were 3 different segments of time. And segment 1 is used to discount the first 5 years of pension checks. Segment 2 is years 6 through 19, and segment 3 is years 20 for the rest of your life. And it uses November, the year prior segment rates, and it uses that year's current unisex mortality tables. So this would have been applicable back in 2017. For the first pension check, $2,000 a month is $24,000. You're owed that money right away on your benefit commencement date. So it's owed to you today. So there's no discounting. So it's actually worth $24,000. And since you've already made it to age 55, you're 100% likely to live to 55. So for that first pension check, you would get all of it. Fast forward 10 years. Now you're 64 years old. You're still owed only $24,000 because there is no cost of living adjustment in this pension. But that is owed to you 10 years from now, not now. But you're going to get the money now. So it's using the second segment to discount that back for 10 years. And so 17,156.75 cents at 3.8% interest for 10 years equals, 16,528.66 at 3.8% interest equals $24,000 in 10 years. And you're only 94.94% likely to live that long. So you would technically get 94.94% of what it would take invested at the segment rate to be what your pension would have been had you taken it as a monthly annuity. And this goes all the way to age 120. For giggles, if you were 55 back in 2017, 55 years from then, you'd be 110. You'd still only be eligible to receive $24,000, but that's owed to you 55 years from now. So using the third segment back in November 2016, it's only $1,909.25, and you're not very likely to make it to age 110, 0.0282%. So you get 54 cents for that whole pension check. And 54 cents is 0.0282% of what it would take invested at the segment rate to turn into what your pension check would be. Then what the pension actuaries do is they take that $24,000 and they make it a 1. So for every dollar in annual pension, it's a conversion factor of 16.67. In this example, for someone exactly age 55 back in 2017, 16.67 times 12 times single life annuity would have been the lump sum amount. These are the factors for 2024. I'm not going to have the 2025 factors until mid-January or early February, or sometimes even late February. It uses the minimum present value segment rates, and you can Google internal revenue. I'll go back to this one. Sorry. The conversion factors, people look at this and they say, wait a second, let's pretend you quit Boeing at 55, so you could retire right away, but you want to wait for 10 years. You notice the numbers go down if you wait. You would think like Social Security, if you wait, the more you wait, the more you should get. But that's not the case, because this is a conversion factor that is used to express the future value of monthly pension checks. And if you were to take the pension at age 55, let's pretend you die at age 90, that's a lot of pension checks. If you took the pension at age 70, you're still going to die around age 90. That's a lot fewer pension checks, So the conversion factor goes down every single month. This is age and months. So it goes down every single month you delay. And then every single year, this whole matrix is recalculated based on new segment rates and new mortality tables. They come from the Internal Revenue Code 417E segment rates. And that's actually identified in your contract. And you can go to, let's see what's if November's there yet. Nope, just October. So no November yet. And November was only 4 days ago. Most likely it's going to be around the 9th or 10th of December before it is ready to go. But you can see, oops. So yeah, the first segment, November 2023 was used for all of 2024. So they assume for the money you're going to pay yourself for the first 5 years of pension checks that you're going to get a 5.5% return on that money. If you take the second bucket of money, if you will, put it into a bucket and don't touch it for 5 years, then draw on it for years 6 through 19, that's 5.76. And then the third segment is years 20 for the rest of your life. So take money, put it into a bucket, then draw on it for the rest of your life. They expect you to get a 5.83%, which possible. I mean, interest rates are kind of high right now, so high. And these are made from high quality corporate bond yield curve spot rates for matching maturities. So this, you can go to, this is where this information came from. But the Treasury Department publishes these. So you can go to treasury.gov, click on data, click on corporate bond yield curve, click on the, not the end of month, but the curve spot rates. And you can see here's, you download an Excel spreadsheet and there's maturity over here. So 6 months, 1 year, 1.5 years, 2 years, 2.5, 3, 3.5, 4, etc. And if you were to average from 6 months to 5, that is from here to here, that is 5.5%, and that's why it's 5.5%. So I don't think it's there yet, but we'll go to treasury.gov real quick. Treasury.gov for data, corporate bond yield curve, Excel spreadsheet, open it up. Nope, just October. So this is October's right there, averages 4.42. So yeah, it's not quite done yet. So this year, from 2022, this November 2022 segment rates would have been used for all the 2023 commencements, and this 23 is used for all 2024 commencements. So when this number goes up, they assume you're going to get a better investment return for that bucket of money, so you get less money in that bucket. So if this number goes higher, you get less money. If this number goes lower, you get more money. And this is the tracking of the segment 1 and segment 2 and segment 3 rates going back in time. And you can see, a lot of your coworkers left in 2022 because they wanted to capture the benefit of super low corporate bond yield rates that were low because of COVID. And so it jumped up a whole bunch. So some folks, a lot of folks left in 2022. This is a more closed up look. So from 2017 through now, past 7 years, maybe. And you can see they kind of spiked here in October of 2023. And then they've dropped since. They're starting to spike back up. They've talked about having more rate cuts in place that would have a trickle down, normally have a trickle down effect. But there's a lot of talk, this is taken from the internet today, about yields spiking because of the politics. So no one knows what's going to happen with November segment rates compared to October. We'll go back a couple slides. It's kind of hard to believe they would be higher than this. That's, what is this, 4.42 to 5.5? That's more than a whole point jump. I don't know that would happen. But it could be worse than it could. And again, I don't do any forecasting, but it's certainly not going to be like it was back in 2022 using 2021 November saving rates 1.02, 2.72, and 3.08. And yeah, 2021 was a great time to take lump sum. A 0.53, 2.31, and 3.09. So yeah, that is the lump sum. If you have questions about lump sum now, you can type those in, and we'll get through the annuity options. And then if you have any other questions about the pension, feel free to type those in too. So if you, this top benefit, the most purest form of annuity is the single life annuity. All the calculations produce a single life annuity amount. And in this example, the employee retires at 55 and dies at 70. Not because Boeing employees die at 70, but just because 70 is in the middle of the screen. And in this example, when you die, it stops, right? The plan default is a 50% joint and survivor. You no longer have to have your spouse sign a notarized affidavit if you choose a larger benefit for your surviving spouse upon your death. But if you do choose lump sum, you will have to have your spouse sign a notarized affidavit. But the plan default is a 50% joint and survivor. So now the plan pays on the life of two people. And because of that, you get less money up front. So you're going to pay 5% to have this option. So while you're alive, you're getting 95% of the single life annuity. And then when you pass away, your spouse gets 50% of what you have been receiving. So 50% of 95% of the single life annuity amount until your spouse dies. The next one is a 75% joint and survivor. It is another cost of 5 or a total cost of 10. So while you're alive, you would get 90% of your single life annuity. And then when you pass away, your surviving spouse would get 75% of what you had been receiving. So 75% of 90%. And lastly, it's the 100% joint and survivor, another cost of 5, so a total cost of 15. And so while you're alive, you would get 85% of the single life annuity. And then when you pass away, your spouse would get 100% of what you have been receiving, so 100% of 85%. We always have two questions that come up right about now. And the first one is, well, what does the average SPIA person do? And that's really the wrong way to think about it. You should look at your own situation and your own financial plan, maybe work with a financial planner and come up with the option that's best for you based on your circumstances. Everyone's circumstances are going to be different and for different reasons too. I'll tell you, my mom died at 50. I'm already older than she was when she passed away. My dad died in his mid 70s before he theoretically should have. So I've got early death in my family. And if I were to choose a single life annuity option, or yeah, it'd be 100% joint and survivor. And so I would pay 15% to protect my spouse in case I die prematurely, because that's what we think might happen most. So knock on wood, let's pretend I do that. And here I am at age 55. I'm paying 15% of this. And so for 10 years, at 65, I've paid 15% of this pension for the past 10 years. But at age 65, maybe my spouse gets into a car wreck and dies. I would call Boeing and notify Boeing of the death of my spouse, and I would bump back up. They call it pop up in the Fidelity vernacular. They call it pop up benefit. So I'd bump back up to single life annuity, and then I would receive the single life annuity amount until I died. I can get married again and again. My new spouses would not get a life benefit. It was only the spouse that I was married to on my benefit commencement date that is eligible for that. Same applies to domestic partnerships. There is a slight corner condition if your spouse is more than 10 years older than you or to more than 10 years younger than you. There's a slight adjustment that occurs. If you have questions about that, let me know. You have the ability to accelerate the income at the expense of later years. So if you think that you're going to die early and you think your spouse is going to die early and you don't want to deal with a lump sum, then you can take the accelerated income option and they will pay you more. And this is only if you're under 62 and 2 months old on your benefit commencement date. They will pay you more until 62 and 2 months, and then $700 less for the rest of your life. And how much more they pay you is defined by how many months you have until 62 and 2 months old. So it's a revenue neutral kind of a prospect for you and for Boeing. So if you were to take the blue line, could be, let's just pretend this is me. So the blue line could be 100% joint survivor. And the red is what I would get with accelerated income option. And the red is what I would get with accelerated. The blue is what I would get without. And so the red above the blue line, if I were to invest that at the segment rates required for this time horizon, it would equal the white between the blue and the red if I died when the books say I was supposed to die. So it's a wash. If I live too long, it's kind of a bizarre logic, a weird way to think about it. But if I or my spouse lived longer than we were supposed to, we would have paid for this option more than we should have, and so we would lose. But if we died early, both of us died early, we would win. We would have gotten more from the pension than we should have, technically. So it's a way to get more out of your pension. The online tools, a lot of questions about this right now. The online tools for all future years assumes a 0% EIP and a 0% lump sum award. The techs are still getting 1% lump sum awards in their Article 11. So they have essentially 1% more that goes into the pension than the profs do. You do get to input an assumed raise, and that will work, but it assumes a 0 EIP and a 0 lump sum award for all future years. And if that is true, then it's going to be fairly accurate going forward. However, any lump sum estimate uses the in-production lump sum conversion factors that are in place right now. This has not been updated. November 23 segment rates. Wow, no one's caught that for 2 years. I guess that's what cold medicine does. It makes you think about things in a new way. So the online tools now use November 2023 segment rates for all future years. And that's not going to be true. So any lump sum estimate for any calendar year other than this current 2024 is going to be inaccurate. You don't know, and you don't know how much. Getting back to this example here, this was a difference of about 30%. Folks that did not leave in 2022 and get the benefit of November 2021 segment rates lost about 30% if they waited, sometimes even just waited 1 month. And some folks had very large pensions at that time. We're talking, $1.2, $1.6 million, and 30% of that is not insignificant. Some of you also have non-union time, the PVP, Pension Value Plan. This is the non-union pension that Boeing introduced in the late 90s, 1999. This is, I think, one of the reasons why the Spear Pross and techs went on strike in 2000. Boeing really wanted to push into this PVP. But the PVP is a different kind of plan. If you were non-union on December 31st, 1998, then all of your prior BSERP, because remember the BSERP was for all Boeing employees nationwide. So if you were non-union on December 31st, 1998, all of your prior BSERP benefit got converted to a heritage PVP benefit. And then that became hard frozen in 2015. In addition to that, your post 1999, well, so post 98, so starting January 1, 1999, is a cash balance hybrid plan, and it continues to grow at 5% until your commencement or until age 65, whichever comes first, independent of your employment, by the way. So if you do have two pensions, you would go to netbenefits.com/Boeing, and you'd have to click on each pension name, and you would commence them independently, and you would get to choose. You could choose maybe 100% joint and survivor for the BSERP, and you could choose a 50% joint and survivor for the PVP. It's your choice. Two different pension plans, two different ways to commence. So we're through the pension section now. If you have questions on the pension, feel free to type them up, and we'll address them in order at the end. A lot of folks also have concerns about Boeing going bankrupt. And with the current rules, if Boeing goes bankrupt and is able to absolve itself of the pension assets and liabilities during the bankruptcy proceedings, then the PBGC would take over. The PBGC would get all the assets of the pension plan and all the liabilities. And this is straight from them. So most participants and beneficiaries receive all the pension benefits they would have received under their old plan, but some may lose, and certainly retiree medical is not guaranteed. And so you'd have to know three things: know when you first started receiving benefits, when your employer entered bankruptcy, and when the plan was terminated. And so let's pretend that 5 years ago at age 60, I retired from Boeing. And here we are now, I'm 65, I've been receiving benefits for 5 years, and Boeing goes bankrupt today. So I first started receiving benefits before Boeing entered bankruptcy. So I would use my age on the date that Boeing entered bankruptcy. So I would use age 65. And so my age 65 payable benefit is 100% guaranteed by the PBGC, up to $7,178, let's just call it. And there's also a 50% joint survivor that is a little bit less. And this assumes that my spouse is the exact same age as me. This number goes all the way up to like 80 something, it goes all the way down to 40 something. So this is just a cutout of the most common ages of the SPIA Prof and Tech retirees. But you can go to pbgc.gov for more information, pbgc.gov. You also get these annual funding reports for the past, how many is that? 15, 16 years now. The plan's been over 100% funded. So even in 2012, when I think it was McNerney back then, was trying to convince folks that the pension was a huge drag on Boeing's ability to do R&D, and that's why in 2013 the profs and techs killed it for new hires. Even after the biggest impacts, the biggest recession since the Great Depression, it was still 100.03% funded when you count all assets. And yeah, last year it was 122, and this year it's 103. These are all the different pension plans. This is the summary of what's mailed out to you every single year. And so it's got net assets. There's a credit. Boeing gets a credit when they stuff money in it when they don't have to. And they've got 4.5 billion of overstuffing in the pension right now. So total plan assets of 54.4 billion, liabilities of 52.4 billion. When you don't count the overstuffing, it's 95.3% funded. When you do count the overfunding, it's 103.9. And I can see people say, whoa, it used to be 122, what happened to 103.9? Well, 2022, this is, by the way, plan year starting 2023. This is as of January 1, 23, which means just ending 2022. And 2022 was, a bad year. A typical asset allocation mix lost 16.5%. Large caps down 18, small caps down 20, real estate down 25. Even the high-grade bonds and high-yield bonds, the junk bonds, were down considerably in 2022. They've since recovered in 2023, and this is maybe halfway through 2024 year to date. But things have recovered. So I expect the next funding report in April or so to reflect that recovery. Again, sorry for coughing. I hope that it's not too loud on the microphone. So that is bankruptcy, that's PBGC, that's the pension. If you have any pension questions now, feel free to type them in. And now we'll get to the Boeing 401k. I don't think this happens anymore. I don't think they send you anything. Again, new fresh eyes on cold medicine. So now that they moved to Fidelity, I think everything's automated, all online. I don't think they send a packet to you anymore. But anyway, when you terminate your employment, you don't have to do anything immediately. You are encouraged to talk with a tax advisor or a financial consultant before deciding which distribution option is best for you, because there are consequences to almost everything that you do, pros and cons. So I did send, let's go back to the packet I sent out. So I sent you one of the PDFs that was sent out, talks about the CFP board of standards, what is the fiduciary care, who has to be a fiduciary, et cetera, et cetera. The fact sheet from the Department of Labor, how to tell if your advisor is working in your best interest, and it's a guide, what kind of questions to ask them. And I should have had this one first, but this is from the National Association of Personal Financial Advisors. This is the pursuit of a financial. So if you don't have a financial advisor, where should you look? What kind of questions should you ask? You should learn about their credentials. You should understand exactly how they're paid, and if what they recommend changes how they're paid, you should have that open and honest discussion with them. You can look at broker check to see if they've been in trouble with the SEC. It's all published on there. You can see how long they've been in business, what kind of clients they have, and that kind of stuff. So I highly recommend that you read this. Great list of questions here, knowing what to ask them. So this is in the packet that was sent out earlier. Highly recommend that you go through that process. But there's 3 different versions of 401k at Boeing: the pre-tax, the Roth, and the after-tax. A lot of folks think that after-tax and Roth are the same thing because they focus on the contributions only. And the contributions for Roth and after-tax are both made with after-tax money. But the Roth is subject to the same 402G limit. It's a combined limit as the pre-tax. This is a shared limit. You get matching whether you do, and the after-tax is not subject to this 402G limit. So once you save 23,000 plus catch-up, you can start saving money in the after-tax 401k over and above beyond that 23,000 plus catch-up. Yes, you get matched. Sorry. Yes, you get matched whether you put it in the pre-tax or the Roth or the after-tax. And the matching I have identified for the next contract for it to be made more clear. The matching occurs on every single paycheck. It's not, if you you can put up, I think, 50% of your salary in the 401k. And so if you put 50% of your paychecks for the first, half of the year, that's 25% of your total pay for the year. That's more than 8. And so you think you would get the maximum matching, but it occurs each and every paycheck. So you're matched 75% of just the first 8 that you put away every single paycheck, no more than that. The gains are treated differently. The gains on pre-tax are tax deferred. The gains on Roth are tax free, and that's the one benefit of doing things in a Roth. The gains of after tax are tax deferred. There's also a 415C limit, which is the most you can put in a Roth, after tax, and pre-tax. Combine your money plus Boeing's matching plus Boeing's non-matching money. And the catch-up is a completely different election, and it's not matched at all. If someone tells you the catch-up is matched, they're talking about the non-union version, which is has a different set of rules. So the after-tax, has one other unique aspect to it, and it allows what's called in-service distributions. The pre-tax and the Roth do not have in-service distributions, but the after-tax does. In-service distributions mean you can take the money out while you're still an employee. And one of the most popular ways to use the in-service distribution option is to do what's called a mega backdoor Roth. You can put money, you don't have to do pre-tax and Roth first. So you do not have to fill in this 23,000. You can go straight to after-tax if you want to. And a lot of folks do that now. So you can make after-tax contributions, and then once a quarter, once every 6 months, once a year, or whenever you want to, you can roll those contributions out directly to a Roth IRA outside of Boeing. An IRA is individual retirement account, so not Boeing sponsored. The gains those contributions have made must come out at the same time, and those can roll directly to a traditional IRA. Next, go back. The gains on after-tax are tax deferred. So the after-tax contributions roll to Roth. The tax-deferred gains go to a tax-deferred traditional IRA. Because you're not changing the tax status of anything, there's no additional taxes required to do this mega backdoor Roth when you move your money to IRAs outside of Boeing. And the reason why you might want to consider this is next year's gains on those contributions will be income tax-free now that it's in a Roth IRA. The tax-deferred gains will still be tax-deferred. So that's a very popular thing to do. The other way to convert stuff to Roth is to do what's called an in-plan conversion. You can now do multiple conversions per year. you have to convert whatever gains were with your contributions, and whatever you have not yet paid tax on, you will pay tax on when you do an in-plan conversion. So different than the top half, if you do what's called an in-plan conversion and you convert after tax, then you're going to owe tax on your gains that you have not yet paid tax on. You do also have the ability to call Fidelity and to establish a nightly sweep. And so this means if there's a penny in your after-tax 401k, it'll convert it to Roth 401k. Every single night, it'll like a little computer go in there like a robot. It'll try and find money in after-tax, convert to Roth. And the reason why you might want to consider that after you maybe you want to do the top half first, and that way you don't owe additional taxes. So your contributions over the years to a Roth IRA, your gains over the years to a traditional IRA, and now you're back to zero. You've got no money in your after tax. Then you can call them and say, hey, I want to do a sweep nightly. That way, if every single night the money in the after tax is converted to Roth, there's no time for any gains. So there's no gains, so no tax. And the converted amounts have the same distribution rights as it had prior to the conversion. So it still has the in-service distribution option, but now it's in a Roth 401k. It's called Roth from after tax is the bucket you'll see at Fidelity. So two popular things. If you have questions, you can email me about those. We should probably have a whole seminar just on that at some point. Because this, well, Biden's budget, I was going to get rid of it. It's literally a loophole for high paid individuals to stuff money into Roths. This was, if this top half before September 2014, if you would have said, I want to do this and lined up 100 financial advisors, half would have said, don't do it. The rules don't say you can do this. You're going to get caught, because this is nowhere near the intent of how much money you can put into a Roth IRA and who can put money into a Roth IRA. I think right now it's married filing joint under 236,000 for a full contribution. So if you make more than 236,000 married filing joint, I believe you can't make a Roth IRA contribution at all. But you can still use this process. It's a backdoor to get money into a Roth IRA. So it is a loophole. The Obama administration back in 2014 said, it's a loophole, we got to get rid of it. And so for 2015 and 2016, it was on the chopping block. Then in 2017, we had a new administration that probably likes loopholes for rich and famous people. And so it was not touched for those 4 years. Then when Biden came back, it was going to be put on the chopping block again. This is March of this year, by the way, March of 2024. And they talked about eliminating it. And, now that we have that same administration again, the Trump administration, I don't see this as being at risk anymore. But still, you'll want to watch the news, because the way that they would eliminate it is not allowing Roth conversions if any of the money includes after-tax money. That was how the Obama administration was going to do it, and that's how the Biden administration was going to do it. But hopefully it doesn't go anywhere. It's kind of a neat trick. It's a way for people to stuff a whole bunch of money into a Roth IRA that technically shouldn't be eligible to. It's a loophole. So regarding your the pre-tax 401k, by default, all of your withdrawals are proportionate across all money types and across all funds. And that's, if you think about it, that's kind of the way it should be. If you've got a third Roth, a third after tax, and a third pre-tax, and you're 60-40 S&P 500 in bonds, if you take out 100 grand, you'd still want to have that same allocation and the same essentially bucket in the mix of money. I now realize why I'm coughing so much. My cold medicine is wearing off. So sorry about that. I should have taken some before the presentation. If you take an early distribution, there's a 10% penalty. There are 3 different exceptions. There's actually 16 exceptions, but the 3 most common are here on the screen. The first one is made on or after the day you attain age 59 and a half. 59 and a half is a special age. Most of you know about that. The next one is made to someone in a substantially equal periodic and amounts that are substantially equal periodic payments throughout your lifetime, or I think technically 5 years or 59 and a half, whichever's later. I think there's 3 different ways to determine substantially equal. But if you're 42 years old and your expenses are low enough, you can technically retire and take substantially equal periodic payments throughout your expected lifetime, and you will not have a 10% penalty from your 401k as a 42-year-old. So that's a good thing. And then the last one that is one of the 3 most common, but it's probably the most common for Boeing employees and probably the least well known. It says made to an employee after separation from service after attainment of age 55. And I can hear people, I know you can't see me, I can't see you, but I can imagine you scratching your head right now saying, wait a second, is it 59 and a half or is it 55? And it's 59 and a half for any 401k or any IRA. It's 55 from just the 401k of only the employer that you just left, if you left that employer the tax year you were over 55. 55 or older. So this one, there's no 6-year bridge for this. If you're laid off at 49, you don't get to do this. But if you leave Boeing today at age 55 and you want to make withdrawals from your 401k, you can do that as much or as little as you would like. If you take Boeing's 401k, however, and roll it into an IRA, now you have to wait till 59 and a half. So the way around that is you could take half of your 401k and roll it to an IRA, and the other half you can tap into between 55 and 59 and a half. So there's ways around it, but this is it's a powerful tool to access your money with no 10% penalty at age 55. If you have just come from another employer to Boeing and you're in your mid 50s, you might want to consider rolling that prior employer's 401k money into Boeing's 401k. Then it will be in the 401k of the employer that you're leaving if you leave the tax year you're 55 or older. So it doesn't matter where the money was before, it matters where the money is the day you separate service, the day you quit/retire. You can now, due to interim negotiations with Boeing 6 years ago, you can now, it was COVID. It was COVID time, so it was a CARES Act distribution, I think. You can change installments monthly now. So prior to this side letter, you only got one installment option and you could never change it. But now you can essentially set up kind of like a paycheck, kind of like a pension check. You could log into Fidelity and say, I want, $2,300 a month. Here's my bank routing number. And every single month, first banking day of the month, they will liquidate some shares and they'll deposit $2,300. Where you're going to fill out a W-4 form for taxes, but the after-tax equivalent of $2,300, whatever you ask for, every single month. Very, very easy. And you can now change it up to once a month, which is nice. So it's pretty easy to access your money and to kind of give yourself a paycheck and leave your money invested. You can also do a partial lump sum distribution if you want that new Rivian pickup truck, the new nice one, the quad motor. It's going to be whatever, $110,000. If you do a partial lump sum distribution, they will withhold 20%, 20% no matter what. And so you're going to get 80% of whatever you ask for. And you can do combinations of installments and partial lump sum distributions if you want. So I could say, maybe give me $3,000 a month in installments. If I need more money, I can do a partial lump sum distribution. Or if I have too much money, I could reduce my installments the next month. So there's lots of ways to access your money. It's very flexible. You can also do a full distribution. In this context, it really means take everything, roll to an IRA, except for you have the option to take the Boeing Company stock fund as cash or in kind as shares of Boeing stock. There's a process called net unrealized appreciation that you will want to learn about if you have enough highly appreciated Boeing Company stock fund. With Boeing Company stock being so low, I'll pull up my phone and see what it closed at today. But with Boeing Company stock fund being so low, there's probably fewer and fewer of you that would take advantage of this. I actually took it off my top 10. But if you do have enough highly appreciated company stock fund, you're going to want to educate yourself on NUA, net unrealized appreciation. It's a way to pay less in taxes on the appreciation of the company stock fund when it's converted to actual shares. You can also wait. A lot of folks live well beneath their means and they don't want to take, why would you take money you don't need only to pay taxes on it? Well, the government wants their taxes, and they have now what's called required minimum distributions. And it gets kind of confusing because now there's four numbers technically, but it used to be 70 and a half, and it used to be April, the year after you turned 70 and a half, you had to make the first required minimum distribution. That would have been for the prior year. You'd make another one that year for that year. Then it changed to 72. Then Secure Act 2.0 changed to 73 or even 75, I think in 2035. So educate yourself about the RMDs, and it matters how old you are or were when these things happen. So if you were already required, if you were already 70 and a half, when the Secure Act 1.0 happened, then you're required to take them at 70 and a half. So you just learn about the RMDs, and you can roll Boeing's 401k into an IRA or another employer's 401k, or you can even receive a commercial period certain annuity. So annuities used to get a bad name, and there's a company called, I think, Hewler Income Solutions is a company that you can get access to through the Boeing 401k through Fidelity. And when interest rates, were zero for the past 15 years, 20 years, it made almost no sense to even consider an annuity. But now the interest rates are, 4.5, 4.3, 4.75, 5, whatever. It's much more enticing to consider an annuity. Keep in mind that annuities, unlike the pension, annuities are guaranteed by the various guarantee associations of each state. So Washington State will guarantee in the event the life insurance company went bankrupt, Washington would guarantee the present value of up to $500,000 of future benefits. So I wouldn't probably ever consider doing more than $500,000. But if that's a part of your plan, this is not a bad idea to consider that now. Here is a slide about the NUA process. Again, if you'd like this in large print, this was emailed out in smaller print to you if you'd like it large. This is also in your 401k SPD. And required minimum distributions. So the required minimum distributions are an ever increasing percent of the immediate prior year's closing balance. So at 79, you're going to take out about 5% of what your balance was at the end of your year 78, the year prior. Somewhere around age 86, you'll take out 7% of your balance. Goes up and up and up. If you have an outstanding loan, you can continue making loan payments or not. If you don't make a loan payment for 90 days, it's considered a constructive distribution, as if you took the money out that day, and so you'll owe income tax on it and potentially a penalty. So now if you have any 401k questions, feel free to type them in, and then we will go on to retiree medical. The retiree medical isn't locked in, and this kind of gets people scared. And it could and should make you pay attention. Certainly, the benefits can change, and we know that has happened. In the 2016 contract negotiations, the negotiating team, the unit ratified a deal that changed the traditional medical plan from a deductible of 0.225% of your base salary or to $300. And also the co-insurance for hospitals went from 100% down to 90%. And so those changes were not beneficial to anyone who went to the hospital, right? You end up paying more when you go to the hospital. You'll have deductible, you have co-insurance, 10% co-insurance until you hit your out-of-pocket max. All those changes that were put in place for the active employees in January 2018 also impacted everybody on retiree medical, and they didn't get the vote on it. So certainly it has changed in the past. Now, whether Boeing can delete it or not, like completely delete it, that's up for a future legal fight. Right now, in your contract, Article 16 protects everyone who retires during this contract and prior. So there's protections in the contract. If the contract were to be negotiated differently and the protections were taken away, then it would be up to Boeing to decide what to do. Whether if you were Boeing, would you just not let new people take it, or would you cancel it for everyone? Who knows? But as long as the protections remain, Boeing can't take it away or change it, unless it's negotiated, of course, right? Retiree medical can start as early as age 55, and it ends when you turn Medicare eligible. Everyone becomes Medicare eligible on the first of the month when they're technically 64 and 11 months old. So it ends at 64 and 11 months, not age 65. And you have to have left Boeing after age 55. You have to have 10 years of service, and you have to have been most recently hired before 2007. So everyone who was most recently hired before 2007 does have more than 10 years of Boeing service. So really, it's last hired before 2007 and leave after 55 is the key indicators. If you're eligible for this, you get a 1-month extension of active medical and dental coverage. So if you were to, let's pretend the stars aligned, that February 2026 thing. Let's pretend whatever the second paycheck in this February, you end up terminating your employment on February 28th, and you commence your pension on March 1st. You always get through the end of the month. And if you're eligible for this, last hired before 2007 and left after age 55, you get a 1-month extension of active coverage. So that would be the month of March. And then your retiree medical would start in April. Your spouse and other dependents are eligible also until whatever limiting age, whether it's kids through 26 or spouses until 64 and 11 months when they become eligible for Medicare. You can get married in retirement and add new spouses, and you can make babies if you want to and add new babies. You can adopt kids if you want to, as long as they're under 26, and add them to the plan. The non-union cannot. So they only get to have who they had on the plan the day they retired. So that's one difference also between union and non-union. The coverage is exactly the same as the active employees, but the premiums are very different. And when I say exactly the same, it's the exact same coverage. It is a different drug card, it's a different BIN number, a different ID card, because it's a different group, but it's the exact same plan. And even if you satisfied your deductible before you retire, let's pretend you retire in July and you're on the Advantage Plus plan with a high deductible with a family. If you've met that deductible, you can call. If they don't do it automatically, you just call them and they will give you credit for meeting that deductible on your retiree plan. There isn't any dental coverage in retirement. You can extend your active coverage through COBRA. It's $57 and $14 a month times 1 if you're covering yourself, or times 3 if it's a full family. So no retiree dental. And a lot of folks get hung up on that. If you think about it, let's pretend you don't have medical insurance and you get cancer. Well, you might have to sell your house. If you don't have dental insurance, the best benefit dental is discounts and up to $2,000 in benefits. So it's not going to make you sell your house. So not having dental is not that big of a deal. But I wouldn't let the lack of dental stop my retiring. If it were me right now, I've got 2 kids with braces still. So I would pay for COBRA for just the 2 kids until their braces came off. You don't have to keep all 18 months. You can just do it for 12 months or 6 months if you want to. And there's a Medicare Advantage plan available after 65 if you're eligible for this early medical without proof of insurability. So how much you pay for this is based on your most recent hire date into the Boeing universe, including a 6-year bridge for every prior layoff you've had throughout the Boeing universe. So you could have been hired in Mississippi in '89 and transferred to Kennedy Space Center in 2003, get laid off from Kennedy in 2003, in 2006, less than 6 years later, take a job in St. Louis, non-union, and then transfer to Puget Sound, and you get to keep your 1989 date. So it's a 6-year bridge each time you're laid off, and as long as you're rehired into the Boeing universe, then you get to keep your prior eligibility date. And if you were last hired before 1993, you get full benefits under 16.4A, which means you pay band 1 for the active employees, regardless of what your salary, even if you're making 300 grand. I think our highest paid prof right now is 347,000 monthly base salary. I'm sorry, not monthly, annual base salary. That person, if they were eligible and hired before 93, would pay band 1 for active employee rates. And if you're last hired between 93 and 2006, you get partial benefits. And this means that Boeing pays 3 1/3% of the healthcare cost per year of your company service, not pension credited service. And you pay the remainder, but you're not going to pay less than pay band 1 for active employees. I've got an example here. I don't have the 2025 rates yet, but 18 years of service, 18 times the 3 1/3 is 60% paid by Boeing, which means 40% paid by me. 2024 traditional rate, 950.06. If it's you and a spouse, that'd be times 2. So you and a spouse is 950 times 2 times my 40% is $760 a month. And you can look at that and say, that's a lot more than you're paying now. And it sure is. But before you say no to this, go look and see what else you have as an option outside of Boeing. And most likely you'll grab this and be thankful for it. If you're last hired after 2007, you get nothing. And unfortunately, I've had a lot of people who have been job shoppers, contractors. And so you're a contractor for a while, then you're a full-time employee, then you're a contractor for a while, then you're a full-time employee, then you're a contractor for a while. You know, if your last hire date as a direct employee was after 2007, no medical. And I've had surviving spouses. I had a contractor die, and his spouse called the union and said, I need to know about my husband's pension and his retiree medical. And we're like, well, he was a contractor. He was not an employee. He didn't have, and she started crying. He was always employed by Boeing. Well, he wasn't technically, he was a contractor. So, so pay band 1 rates for new employees, it's 0% for Advantage Plus. That's a free healthcare plan. So if you have been hired before 93, most recently, you get Advantage Plus for free. Or if you were hired between 93 and 2006 and you have more than 30 years of service, 30 times 3 1/3 is 100%. So that makes it also a free plan. Traditional is 6%, and this is what the 6% is for traditional here, and 12% for everything else for Kaiser and Select Network. So it's really reasonable, especially if you have 30 years of service. There is a corner condition, and so if you are older than your spouse, and if you want your spouse to have Boeing insurance, then you have to have Boeing insurance too. And so when you turn 65 or 64 and 11 months old, technically, you are only eligible for this new Medicare Advantage plan. And if you don't take the Medicare Advantage plan, then your spouse cannot have Boeing insurance. There's one other kind of corner condition. It's when you are a Boeing employee and you're married to your spouse, and your spouse is also a Boeing employee. If you both have retiree medical, you have to take the medical you're eligible for based on your own work history. If one of you is eligible for medical and the other is not based on that, then the person who's not eligible can be a spouse of the one who, a spouse dependent on the medical plan of the one who is eligible. So this new Medicare Advantage plan, it's new for January 2024. The plan used to be what's called a Boeing Medicare Supplement Plan. This plan is a single card. It's a Medicare Advantage plan. It's called an Extended Service Area. It's a PPO, not an HMO. So it's a PPO with an extended service area. Has other benefit enhancements. So hearing aid sneakers, silver sneakers, free gym memberships, meal delivery benefit for up to 7 days following a hospital admission. You can click on this at themedicare.com/Boeing, EN for English, then index, and go to plan option D. I'm going to show you how to do that real quick because that does get kind of confusing. See what's covered, I think. Yeah, plan letter D, dog. And so here's all the Boeing plans. Choose your plan year, 2025. Here's the evidence of coverage. So there's lots of stuff on here. What's covered, what's not covered. Here we go. Excuse me again. So this was negotiated, and the premium is expected to be 0 for the next 5 years through the 2028 calendar year, unless there are enrollment changes or legislative or funding changes for Medicare Advantage plans. So it's expected to be free for a long time. 95.6% of the providers that have submitted bills for the Boeing Medicare supplement also can submit bills and are considered in network for the Aetna plan. The Everett Clinic and Mayo Clinic, Everett Clinic and Polyclinic are in network. The Mayo Clinic is not in network. 98% of the pharmacies that submitted drugs in the prior 2 years before this were in network. 99.7% of formulary match, and it saves 110 million. There's 5,064 SPIA represented retirees and or spouses in this plan. There are 50,000 non-union in this plan, so 55,000 total people. Monthly cost is 0. Deductible is lower. The out-of-pocket max is lower, and yeah, it's a good plan. So Aetna, there's some confusing aspects to it though. It's a PPO with an extended service area, the ESA. So as long as your doctor is eligible to receive payment under Medicare and willing to bill and accept payments from Aetna, then your doctor will be treated as in network, even if they're not in network. So in the big places like, the Everett Clinic, Swedish, Aetna will negotiate with those large clinics, and they will have a contract with those large clinics, and they'll be in network. So when you go to the Aetna website, you can look for in network hospitals and doctors. But if you were, an hour and a half north of Spokane, retired, Aetna is not going to drive out there and negotiate with the mom and pop doctor in your small town. So to get around that, I guess it would be administratively burdensome to do that negotiation. They just say, hey, anyone who's willing to bill Medicare, anyone eligible to bill Medicare and willing to bill and accept payment from Aetna will be treated as in network. And yeah, there's a phone number down the bottom. So this has proven to be kind of the trick to understand this plan better. So last couple things, you have a benefit commencement date. That's the day your pension commences. It can only be the first of a month. So people use the word retire really loosely. And from, retiring medical and from pension and from Boeing's perspective, the word retire doesn't even kind of exist. You can terminate your employment and you can commence your pension. So you can only commence your pension on the first of a month. Most likely you're not going to get a pension check on the first on your benefit commencement date, but most likely a double check on the next month and then single checks thereafter. If you've been divorced, you should add an extra month for each of those divorces you've had. I once had a guy in Everett slap his forehead and say, oh my God, 5 months? How am I going to make it? Because he had 5 divorces. Funny, but not funny. But you do have the potential to submit everything early and get paid early. So I believe the kind of threshold, the threshold is if you get everything submitted and 100% done more than a month before your benefit commencement date, then it's not unreasonable to expect you to get your pension check on your benefit commencement date. But there's no guarantee about that. Your last check will be all of your unused vacation paid out at your hourly rate. If you leave the company after 55 with more than 10 years of service, or after 62 with more than 1 year of service, then half of your unused sick leave gets paid out at the lesser of your rate, or $40 an hour. And it's not eligible compensation for the 401k, so it's just cash you're gonna have to take. So some steps to retire. First, make a decision. I know this kind of sounds funny, but you do have to make a decision, and then everything stems from that. Recommend 90 days before the day that you expected to commence your pension, start the process. Go to netbenefits.com/Boeing, collect your pension online. And if you have the two pensions, you would click on both of the pensions to collect them independently, or you can call them. You get a nice, pretty streamlined process. There were a lot of hiccups when Fidelity first came into play, but now they've really upped their game. And so I have not heard complaints anymore whatsoever about the process. And if you do have complaints, or if you have a problem, reach out to me. We can get it resolved real quick. So I get a bat phone on my desk and I call Fidelity, they fix it. So yeah, I've heard very few complaints. It's pretty straightforward. You can upload documents electronically. That tells you a timeline. Yeah, so. And then the last thing you do is self-terminate. So you have to do two things: commence your pension, which is one process. The commencing your pension process, you can start 90 days before your benefit commencement date. The self-termination, if you're not being laid off, you can do that no more than 14 days in advance of your last day of work. And the reason why, when COVID happened, there were voluntary layoffs back in 2020. There were people who were ineligible for voluntary layoffs because they had pre-submitted their termination date like 2 years in advance. They were very proud of their hey, I'm going to retire in 2032. And if you put that date in now, that locked you in, and you could not undo that. And so there are a lot of folks that were ineligible for the voluntary layoff because they had previously submitted their termination date, even though it was a year and a half in the future or whatever. So they've limited that now. You cannot terminate employment more than 40 days in advance. Make sure that you say the reason why you're terminating is a voluntary worker resignation due to retirement. And I've got, put your termination date, primary reason, worker resignation, voluntary retirement. If you say that you're retiring, and if you're leaving after 55, then you're going to get next year's EIP also, based on a pro rata eligible earnings during the performance period of the year that you terminate your employment. So even if you, let's pretend that again, the stars align. So you work until late February 2026. You commence your pension on March 1st. You worked for 2 months, and so you're going to get about 2/12 of a normal EIP paid to you in 2027, based on the 2026 performance year. So make sure that you do that. So now a couple last slides about layoffs, and then we'll open up for questions. We'll have half an hour. I think we'll have plenty of time for questions. So if we had a lot of people when the layoffs first were announced, people said, oh, I got to retire before those layoffs happen. I don't want to get laid off. Totally wrong. You do want to get laid off if you're about to retire, because there's more cash. So it's almost the best thing possible. So the process is to get your actual 60-day notice. When you get your 60-day notice, and if you're ready to retire, you can start the 90-day process for your pension commencement right away. If you choose layoff benefits as a lump sum, you give up recall rights, but you don't care about that because you're going to retire anyway. You have to actually get laid off. Now, for the folks in this round, I believe their layoff date is January 17th. But some folks were laid off and they have a new, what's called a non-working RIF, where maybe you do 5 days of knowledge transfer, then you give your badge, you give your computer, and you go home. You're still a Boeing employee, you're still getting paid until January 17th. So you're not laid off until January 17th. So do not commence your pension before your layoff date. Otherwise, you're not going to get the layoff benefits. So, but if you are laid off, it doesn't matter when you actually get the cash, but it matters that you are actually laid off before your benefit commencement date. So get laid off on January 17th, potentially, then you can commence your pension February 1st. You can enjoy your retirement with that extra layoff cash and go buy a boat. Yeah. So one last thing here, you can also take your pension as a lump sum. Now, granted, it's not as advantageous as it was 2 years ago, but you could take your pension as a lump sum, take the layoff benefits as a lump sum, and then collect unemployment for a while if you wanted to, if you meet the criteria for unemployment and you job searching and that kind of stuff. So what about medical? So if you're eligible for retiree medical, you might want to take retiree medical straight instead of the 3 months of subsidized COBRA, because I'll go back to the retiree medical. Let's pretend you were hired before 93, Advantage Plus is free. Whereas now you're paying a whole bunch of money for it. So 3 months of subsidized COBRA means 3 months of as you're paying as if you were an employee COBRA. So retiree medical might be less expensive than the subsidized COBRA, or it might be more expensive than the retiree COBRA, than the, yeah, your retiree medical might be more expensive than active coverage, the subsidized, or it might be less expensive. You're going to have to figure that out on your own. And if you are over 65, the COBRA is secondary to Medicare A and B. And so you have to make sure that you enroll in A and B. And so now we get to questions. Feel free to type in any question you have. Got half an hour. You hear me, you hear me, you hear me, you hear me. Yeah, so early retiree medical, what does the early mean? Yes, that means before age 65, before Medicare. So someone that has left says, wait a second, we have a pension? I thought we didn't have a pension anymore. Does that BSERP apply just to older service employees? So people who were hired by Boeing before March of 2013 have a BSERP benefit. I'm assuming this is about the pension lump sum, if rolled into the 401k and if under 59.5, then it could be drawn. If in an IRA, then could not be drawn until 59.5 without penalty. Is that right? Well, kind of yes, kind of no. If you recall, there's 16 different exemptions. So there's 16 different, they're all in 72T. So there's 16 different exemptions. The most common ones are here, but if you're not interested in doing substantially equal periodic payments, then yeah, you keep it in the 401k, or maybe like I said, roll half of it to your IRA and keep the other half, or keep what you'll need between 55 and 59.5 in the 401k. Everything else you can roll out. Is there a limit to how much the lump sum benefit? No, great question. So these limits are for contributions, not conversions and not roll-ins. So if you have a $1.6 million pension lump sum, you can roll that whole thing into your pre-tax 401k. Another good question. The old alternate formula. If you were a Boeing employee on January 193, I'll get to it. Yeah, if you were a Boeing employee on January 93, but you left and then you came back, would you still qualify for that third calculation? If you came back and still earned pension credited service, yes. So if you came back before March of 2013, yes. My pension annuity estimate for 100% joint survivor is 89.2% of the single life value rather than 85. That is good, but why the difference? Great question. I did not highlight that, and I apologize. It was red in here, and yeah. So if you recall, if you're within 10 years of your spouse's age, it's supposed to be 5%, 10%, or 15%. However, there's more complex, it's red italics, there's more complex actuarial equivalent factors that can apply based on your age and your spouse's age in whole years of age. And this will only come into play if it's better for you than the cost of 5, 10, or 15%. So this individual says that his 100% joint survivor is 89.2% of the single life annuity rather than 85. That's why, based on your age and your spouse's age in whole years, it is the actuarial value is better for you, and that's why that one's used. You can and maybe should play with a couple other dates also. So let's pretend that I was going to retire, I don't know, let's think April, May, June, or July of next year. And if my spouse and or I have a birthday in April, May, June, or July of next year, then I would want to get estimates for each of those, maybe 2 months before each of our birthdays and 2 months after each of our birthdays, to see if this kind of situation is applicable to me and my spouse. So congratulations, the cost for you for 100% joint survivor is a little bit less than most people. because of this red italics, the actuarial equivalent factor complex. Which benefit calculation method do the online tools use to estimate? So you should be able to get an estimate that uses all three. When you produce an estimate, they are going to give you, I believe, they will give you your years of service, and they will show you what the years of service times $100 is. They'll give you the core plus the excess amount and what those math. So you can get certainly you can get a detailed estimate that goes through all the calculations that goes into it. So if you're just looking at one number, then yeah, it's gonna be the highest one. Oh, good question. Is there a lump sum for the PVP? Yes, there is a lump sum for the PVP. You should take a look at it. It's probably more equivalent now that there's been, now that the BSERP is not as advantageous. There's probably closer benefit, but you could look at lump sum dollar per monthly annuity dollar. So back into the conversion factor for the PVP and compare that to the backed in conversion factor for the BSERP to see, because the PVP is a hybrid cash balance plan, and the notional cash balance earned after 1999 is just a cash balance. You can annuitize that, divide by 1/11, divided by 12, so 1/12 of 1/11 is the monthly benefit of your cash balance, or you just get the cash in that cash balance. So it depends on when you earned the hybrid cash balance PVP, if it's a good deal or not a good deal. So if it were me and if I were you, I would back into, and you're going to see a different conversion factor PVP versus, so lump sum PVP divided by monthly annuity, single life annuity PVP, and do the same thing for the BSERP. And then you should see which one is more advantageous, which one gives you more dollar per dollar. The PVP notional cash balance has no growth past 65 or just something less than 5%. Good question. So the notional cash balance that you earned after 1999, technically it grows at a 30-year treasury bill, no less than 5, no more than 10. And 30-year treasuries have been under 5 for a long time. So it's growing. It used to be 5 1/4. Now it's down to 5 because they changed the laws. But if you're no longer an employee, you're compelled to take the PVP. You can't defer past 65. They will force it upon you, and they'll find you and force you to take it. If you are still employed, then of course you don't have to take that money yet. So if you're working past 65, it will still grow. But if you terminate your employment, they're not going to grow past age 65. If the PBGC takes over, will it provide 100% joint survivor benefits? That's a good question. You should go to pbgc.gov and find out. I do not think they have that option. I think they have a 50% joint survivor option. Where did I go? Yeah, here we go. pbgc.gov. Worker retiree, maybe? No, learn about benefits. So yeah, I would go through this. Here we go. This didn't take very long. You can receive the benefits in one or more ways: straight life annuity, 5-year, 10-year, 15-year certain, a joint and survivor, the monthly benefit, yeah, 57 over 100%. There you go. Or a joint and survivor 50% pop-up. So yes, then, good question. I learned something today. So yes, you can choose 100% joint survivor. The cost of that will not be the same as the cost for the 100% joint survivor for the Boeing plan. If you recall, I didn't, I guess I glossed over it. Let's go back to, where's the present, where's my mouse? There it is. We did talk about this, but what we didn't talk about is this 50% joint survivor is a 10% cost, not a 5% cost. So if it's 10%, maybe it's 20% for 75, and maybe it's 30% for 100% joint survivor, but you'll have to figure that out. And that's only if one goes bankrupt and they get rid of it. Why does the old alternate benefit calculation start to reduce after age 60? think what you'd be looking at is, let's pretend if you ran monthly, the most common reason why I can think of for that is if you were to produce annual estimates, like 1 year away, 2 years away, 3 years away, 4 years away, and 5 years away. they are assuming that these EIPs are zero going forward. So your final average earnings will go down. If you were in BCA, this 2.9% would drop off, the 5.6, the 5.8. So this would drop off your final average earnings for each year once you did 60 months, right? In addition to that, if you recall the formula that I kind of went through, they assume retroactively that each year for the prior 35 years, you got increase. It was the non-agricultural wage index plus 2%. So this number would be dropping off because your EIPs are falling off, and this number would be increasing. So that's most likely why. If you wanted to get a couple detailed, excuse me, detailed pension calculations, I can go through them and work them. You can do the same thing, but I could help you figure it out. So this question doesn't make sense. I'll just read it out loud, and then the person can maybe retype it in. It says 2,000 SPIA hire, laid off in 2021, then rehired in 2019 at 64 years old with 12 years of service. I don't think I'm vested in a pension. So you can't be rehired in 2019 if you were laid off in 2021. Maybe you were laid off in 2019 and rehired in 2021. The pension has a 5-year cliff vesting schedule. So literally, and it's if you work 1,000, it's not work, but you're credited with 45 hours each pay week. And if you have 1,000 points, if you will, then you get a vesting year for that year. So if you were hired in 2000 and you worked for more than 5 calendar years, then yes, you have a vested benefit. But if that person wants to send me, oh, he just corrected it. I deleted it too late. So send me an email, we'll go through it. Is there a significant risk of the retiree medical benefit being taken away in the future contract negotiations? Of course, there's a risk. There's always risks. How likely is it? Probably not likely, but you never know. If these are incredibly contentious, mean, nasty negotiations, then Boeing's going to be incredibly mean and nasty. So yeah, who knows? But even as a retiree, you'll have to pay attention. And as a retiree, you can go to SPIA.org and download the Spotlight and keep yourself up to date. So next question. With the 401k, do they take 20% out with the installments, not just the partial lump sum distribution? Thank you for asking that question. So for partial lump sum distributions, the IRS requires a 20% withhold. Plus, and if you move to a different state, whatever your state income tax is requirement. For the installments, you fill out a W-4, kind of like a paycheck. So you're going to say, you know, I want $5,000 a month. I'm married with 3 kids, and I want an extra $100 taken out every month. So the W-4 form is what you use for installments. The partial lump sum is always 20%. So to answer your question directly, no, they don't take out 20% for the installments. They take out what mathematically you have told them to take out based on your W-4 forms. Another good question. Older workers to get a super 401k catch up in 2025. Workers 60 to 63 have the option to contribute an additional $37.50 above the $700. That's fantastic. That is fantastic. It's not a required modification of the plan, though. So Boeing has chosen not to do that for 2025, and it's most likely that Boeing will put that in place in 2026 when it also changes. There was something else that was going to be changed. Catch-up contributions have to be made in a Roth form. You can no longer do, people that make more than I think $125,000 can no longer make pre-tax catch-up contributions. So that is a required modification. And so that's going to go in place January 2026. This super catch-up for folks with Secure Act 2.0 is not a required change. It is a permissible change. And so Boeing has decided to change that in 2026. Technically, it's possible for Boeing not to allow that change for SPIA. So we're still under a contract. There's no changes that aren't negotiated. So I made sure that Boeing knew that we would not object to that. And I think that we have already given them permission through a different side letter to allow that to occur. And hopefully you guys know where the side letters are. Let's just go to SPIA. Our units, contracts, CARES Act. So the CARES Act side letter allowed extra. Yeah. The parties further understand that if Boeing determines there are other changes that provide additional flexibility regarding loans and withdrawals, not necessarily contributions, but yeah, who knows what's going to happen. Boeing does not have to make that change, and Boeing may make that change only for non-union, just to get us upset right before 2026 negotiations. But yes, that is a permissible thing with the CARES Act. Can you do Roth conversions within the VIP after retirement? Yes, you can. Will exceeding one of those limits for the 402G stop the company on matching? No. So let's just go to this one. So the 402G limit is just the pre-tax and Roth. And what Boeing does is they automatically change your contributions to after tax. So let's just to make math simple. Let's pretend my base salary is $100,000 and I'm putting away 30% into pre-tax. So if I get my way, I should have $30,000 in pre-tax, 30% of $100,000. However, the IRS says I can't do that. So as soon as I hit the 23,000, and that's what, 2/3 the way to 30 maybe. So 2/3 the way through the year, my contributions, even though I said I wanted all pre-tax, it's going to automatically go to after tax so that I continue to get the matching funds from Boeing. If you stop contributing when you hit this, then yes, you will stop getting the match for the rest of the year. On the RMD related slide, it was note that, yeah, starting in 2024, there's no RMDs for Roth 401k, not all 401ks. So no RMDs for Roth 401ks with Secure Act 2.0, and that's in place right now. So it depends on how much money you have in the Roth 401k versus the pre-tax and after-tax. If exceeding the catch-up amount is done, that doesn't likewise stop the company match, does it? No, and again, the catch-up is not matched at all. Catch-up has nothing to do with matching whatsoever. You're not matched at all on any catch-up, period. So you have to make pre-tax, Roth, or after-tax every single paycheck. At least 8% goes into one of these every paycheck to continue getting matching funds from Boeing. What you do with catch-up is completely irrelevant to match. Is the pension lump sum rolled directly to pre-tax subject to contribution limits? No, that's the second time this question. So it's the first time that question's come up, and it came up twice tonight. So no, it is a converted funds essentially. How much do we pay for retiree plus spouse plus children at 55? Well, that depends on if you fall under the pre-93 or the 93 2006. And so if you fall under the pre-93 or if you're 93 to 2006 with 30 years of service, it's the same thing. It's 42. Down here it says if you're single, it's ×1. If you're covering your spouse and children, it's ×3. So if you have 30 years of service, 30, right, 0 times 3 is still 0 for Advantage Plus. But for traditional, it's about $43 a month. ×3 is $126 a month. So for you, yourself, and a spouse and children is 3 times this rate. Next year's rates are going to be about the same. If you are under the contribution percentage formula, so 3 1/3%, it's the 950 times 950.06 times 3 times however many years you have times 3 1/3. If you transfer your Roth 401k balance to a Roth IRA, is there a 5-year seasoning period for that transfer? No, because it was Roth before. Can you do that Roth 401k to Roth IRA transfer while employed and over 59 and a half? Oh, okay. Can you do that Roth 401k to Roth while employed? No, you cannot. Only the well, no, that I don't know. The question is about Roth 401k and what you can do with that money. Can you transfer? I'm assuming you're saying, can I transfer just my Roth IRA? I'm sorry, just my Roth 401k to just a Roth IRA if I'm over 59 and a half years old and employed. Yeah, I believe you can. The in-service distribution option, you would have to call. I don't think you can do that online. You'd have to call them since you're taking specific funds out. So I think you would have to call them, and you should be able to do that. If you find that you can't, let me know, because if you're under 59 and a half, absolutely not. No, you can't. The only thing you can really touch before 59 and a half is the after tax, the in-service distribution. But after 59 and a half, yeah, you should be able to choose which funds you have access to, and you should be able to roll out certain portions of it. So let me know if you can't do that. I'd be surprised. I hired in as IAM hourly in April 2007. IAM still gets retiree medical. Am I eligible for retiree medical even though I'm currently SPIA? So no, you do not. You need to, yes, you need to change jobs back to IAM hourly before you retire. So retiree medical is based on where you are the day you retire, not where you've been your whole career, which is different than the pension. So the pension follows you around. So yeah, the IAM today still gets retiree medical for new hires. SPIA doesn't. SPIA non-union doesn't for anyone non-union hired after 99. SPIA doesn't for any SPIA folks, SPIA retirees hired after 2007, and the IAM still gets it. So if you retire from a SPIA position, you're based on these rules, this contract. Where do I sign up and pay for retiree medical? WorkLife online, yeah. What is the advantage of Boeing Aetna Advantage just versus Aetna Advantage? Well, so this person isn't here anymore, but the Aetna plan is really nice. You can go to Aetna.com and just get a quote for a Medicare Advantage plan and just try and match the benefits. Here's the $100 deductible, $800 out-of-pocket max for free. Good luck. It's way better than anybody else gets out in the normal marketplace. Is a SPIA represented retiree still eligible for retiree medical if they were a religious objector, not paying union dues, but paying the equivalent amount to an eligible charity? Yeah, you are. You know, there's some caveats where even in this is going to sound funny, a double negative, even in a non-right to work state like Washington, for Washington, in this contract, it's agency fee, so people have to pay union dues, even if they don't want to be a member. There are Beck objectors and there are religious objectors. So some people are firm in their religious beliefs, and there's only a certain religions that permit this kind of a thing, where they do not believe in unions, kind of a thing. And so, yeah, you as a religious objector get all the benefits of the contract, just like anyone else does. Which is the same. I just came back from Wichita. We had our engineers in Wichita negotiated a new contract, and they had 52% membership. That is a right to work state. So not everyone there has to pay dues. And it's difficult negotiating when, you know, half or less than half of the group wants to pay dues. Yeah. Confirming spouse and or dependents use my year of service in their rate calculation. Is this monthly rate fixed or does it increase every year? If so, what is the yearly increase? Will full-time or part-time work negatively impact retiree medical? So yes, confirming spouse and children, you use your years of service in their rate calculation, and the monthly rate is not fixed. I'll go back to the rate this year. Traditional, I think last year was 947. I'm sorry, 2 years ago it was 947. This year it's 950. It might be 954. It does not go up that much, maybe 2, 3, 4%, 5% per year. So it does go up though. Then second question, will full-time or part-time work negatively impact retiree medical? No, but it will impact active medical. If you're part-time scheduled less than 32.1 hours, then you pay 40% of the cost of medical, a whole bunch more. Someone typed a whole bunch about a Medicare Advantage. I'm having a hard time seeing the whole thing to read it. It appears this person cut and pasted a lot of stuff that are, yeah. So I'm going to read this a little bit and then I'll refute it. The person's still online. So it's not a question. He's making the person, he or she, is making a statement about issues with Medicare Advantage plans. Include the inability to revert back to traditional Medicare plus Medicare supplement without going through underwriting, more stringent application of requirements for prior authorization, resulting in more frequent delays. And then finally, a question, is there any reason to think that the Boeing offered at the Medicare Advantage plan would be superior to the general population Medicare Advantage plans when it comes to any of the perceived potential issues? Yes, your perceived potential issues do not exist. Number one, about the inability to revert back. This is an employer-sponsored employer health group plan, and it supersedes all of the other rules for normal Medicare Advantage plans. So anyone who voluntarily signs up for this plan, even if they're not in their first trial right period. So the first trial right is if you sign up within the first time you become Medicare eligible, you have 12 months to get out of any Medicare Advantage plan nationwide. That's fine. In addition to that, though, anyone leaving this plan has guarantee issue rights to another plan because it's an employer-sponsored plan. So that first one doesn't apply to Boeing retirees in this plan. And secondly, more stringent applications. No, that's not true. So there was a law change. I have, we're going to go to my email real quick. Certain questions come up so often. I have shortcuts that help me do my work. So don't look at my emails. Make it big so you can't see. So I just type in BMSP. So April 2023, Medicare and Medicaid services said that all Medicare, they changed the law. So yeah, before 2023, there were nightmares, right, of people, hey, if I had Medicare, this would have been approved a long time ago. So much so they changed the laws. So Medicare Advantage plans have to make the medical necessity determinations based on the policies that are no more restrictive than traditional Medicare national and local coverage policies. And they have to provide coverage for everything that would have been covered for A and B anyway. So yes, that used to be the case. You're looking at old news though. So that is not the case anymore. Did I lose everybody? Oh, there it is. Gotcha. The wrong side of the screen. So yeah, there used to be issues. There were some serious issues with Medicare Advantage plans. Those issues do not exist anymore. If we have questions regarding choosing the best Medicare options for us, is there someone at Boeing to call or email? No, there is not. This, you are going to be making the same decision that every single retiree in the United States makes. Whether you want a Medicare supplement or Medicare Advantage plan, that is a personal decision. You have to make the choice. You can, there's a document called Medicare and You, and so I'd read that document. I'd read Choosing a Medigap Policy. Those are two, I'd quote, search for those documents. If you can't find them, send me an email and I can send them to you. I've got the most recent versions. And then, yeah, read it and then make a decision. I would learn about other Medicare Advantage plans and then compare the Boeing plan to those ones that you learned about. So you're gonna have to do some research. Workday and Fidelity say a 30-day notice is acceptable for proposed termination date. Is it really only 14 days? As far as I know, it's 14 days. I think what maybe you're saying is 30 notice for the pension commencement. And I'll go back to that part of the presentation. How to retire. And this is, yeah. So option one, at least 30 days, but no more than 90 days for your benefit commencement date. So no, it's my understanding it's still 14 days. Does it make sense to go into retiree medical or wait until Medicare eligible to retire? That's a decision you need to make. No one can make that decision but you. So a lot of people historically have said, you know, what's the best way to get the most money? It's just still work. I mean, when you're working, you get full benefits, full pay, you get bonuses, you get sick time and vacation time. The most money is to keep working. And at some point, you're tired of working and you want to do other things. And if you're financially prepared, that's when you retire. Again, starting in 2024, yeah. So I should have highlighted that. It was in red. But yeah, in 2024, the Roth 401k does not have an RMD, not the other parts of the 401k, just the Roth. When I look at my pension amount on the website, why doesn't it take into an early retirement age of say 55 or 58? It should. You should be able to put in a proposed termination date and a proposed benefit commencement date, and it should take those adjustments and do the math for you. So it should give you what your benefit will be at that time. How much do we pay for retiree plus spouse plus children at age 55? Is the premium paid per individual or per family? I kind of went through this before. I'm getting repeated questions. So the retiree medical is based on the rates, and it's a single rate for an employee times 1, times 2, or times 3. Times 3 if it's a full family. So this person, if you have more questions, shoot me an email, please. Oh, again, retiree medical, confirming spouse and dependents use, there must have been a hiccup in the matrix. They have the same questions. So yes, spouse and dependents use the employee's years of service. That is unless the spouse is also an employee, right? Yeah, so a coworker took your retirement seminar in 2020 and forwarded me some spreadsheets which I like to play with. I have not updated those since then. You know, sure, if I had more time, I could. The main reason why I haven't is because there isn't going to be that much change anymore. There was a massive change, dropping down and increasing. We expected this second COVID variant is what made the rates were going way up here, and so we were expecting big jumps. Like we were expecting this jump to happen here, and it simply didn't happen because the second COVID variant happened. Yeah, I have not updated that spreadsheet. Yes, it's fun to play with. You can still play with it. I mean, you can type in whatever you think the saving rates are going to be. The mortality tables have not changed that much. Maybe it's a little bit, 1% worse. But yeah, I have not updated that. How does HSA account work in conjunction with retiree medical? So your HSA, assuming that the money went in appropriately when you were an eligible individual, that HSA money can be used at any time for any future medical expense, even when you're no longer covered by that high deductible plan. So if you want to be on Medicare, you can use your HSA to pay for your Medicare deductibles and that kind of stuff. So HSAs are pretty universal. The rules for HSAs apply to every single person who has an HSA, so they are universal. And you can quickly and easy find out what you can use your HSA for. One of the things that I'm going to use mine for is Medicare Part B premiums. You can pay for Medicare Part B premiums income tax free with your HSA funds. If Boeing ever did charge a fee for the Medicare Advantage plan, you can use your HSA to pay for Medicare Advantage premiums also. There's lots of stuff you can use your HSA for. It doesn't go away, it's still yours. One thing that will change when you're no longer an employee though, is that you'll start paying a monthly administrative fee. to have your HSA at. I think Health Equity is who Boeing uses. Spirit uses HSAbank.com. But you can transition your, you can transfer, just like you can in IRA, you can move to a different HSA custodian. And Fidelity actually has fee-free HSAs, so you cannot pay a monthly administrative fee. Retiree medical, is the monthly rate fixed or does it increase per year? If so, what is the entry? Yeah, again, the matrix. So yeah, yes, the rate does go up every single year. It's based on the illness burden of the retirees as a group. Where's the retiree medical rates? Yeah, so this maybe it's 4%, 5%, 6% more per year. Yes, I did say the Aetna plan for Medicare eligible retirees has a 0 premium, and it's expected to be 0 premium through the end of 2028. Will full-time or part-time work negatively impact retiree medical? Again, yeah, same question. Partial lump sum distribution question, is there a penalty of 20%? So it's not a penalty. So no, let's go back to the. So partial lump sum distributions have a 20% withhold. They're withholding taxes. You'll find out what you really owe when you file your taxes, but they're required to withhold 20%. It's not for a penalty. It is for income tax withholding. Oh, good question. After retirement, what are the SSP withdrawal options? There are none, or you already chose it. So the SSP is the supplemental savings plan intended entirely to get around this 415C limit. So if you save once, that highest paid person I brought up was base salary of 347. That person can't even save 8% to get the match without hitting this limit with Boeing's matching money and Boeing's non-matching money. So the SSP was negotiated to allow people to get around this 415C limit. When you enrolled in the SSP, you can choose distribution options, and most likely it's going to be, over 10 or 15 years. I can pull up the SSP. If you want the SSP SPD, send me an email. Oh, come on. My computer doesn't like me. But there is an SPD for the SSP. I thought I downloaded it recently. Certainly you can find it. SSP right there. Table of contents, SPD, no, that's right, blah, blah, blah. If you can get the real version of this, it'd be nice. This one's not keyword searchable because people at Boeing think that I don't deserve that. But if you could find the real version of this and just right click save it as something and then send it to me, that'd be great. So contributions go in, matching contributions, investing your money, blah, blah, blah. Payments and timing. If you do nothing, your entire SSP is paid in January, the calendar year after your termination. Or you can sign up for annual installments for a specified number of years up to 15 years. The amount of each payment is the equal value of your account divided the number of remaining years. So you should set up how you want to receive your SSP. If you didn't, the whole thing lump sum next January. If you retire at 55 from Boeing, withdraw from do you pay a penalty if you take another job somewhere else? I don't think you do, no, because you did retire from Boeing the tax year were 55 or older. How do I know if I'm eligible for retiree medical? Hired date was 1998 with a straight 26 years of service. Part-time, 10 years as SPIA. And you put your part-time as SPIA from 2011 through 2021, which means right now you're not SPIA, I think. If you're not SPIA, this presentation is not for you. and your eligibility is completely different. So if you're not SPIA, I'm not going to answer that. But if you were SPIA, 1998 is between 93 and 2006. You have 26 years to 26 times 3 1/3. That's how you'd figure it out, right? We kind of went through that. The retiree medical hired before 93, what is the cost for Advantage Plus for pay bands higher than $100,000? It doesn't matter. So it is regardless of your pay, you pay band 1 rates. So it's 0. Yeah. Does a 6-year bridge only apply to layoffs, also for voluntary departures to work somewhere else? No, it is specifically only for layoffs. The 6-year bridge is only for layoffs. If you quit and come back, you get a new last hire date. I am 67 and retiring. My wife is 62. How does health coverage work for them if I end up not using the Boeing Medicare retirement? I was hired in 97 as IM and changed over to SPIA. Well, if you were hired in 97 as IM and changed over to SPIA, 97 is before 2007, so you are eligible for the Boeing Medicare Advantage plan, and then your spouse can have what you would have been eligible for, but not for your age. So if you voluntarily choose not to take the Boeing Aetna Medicare Advantage plan because you're over 65, then you're going to want to research that, and I think you're going to find that you're thinking incorrectly. So most likely, if you were last hired by Boeing in 97 and you're going to retire at 67, you're going to sign up for the Boeing Medicare Advantage plan, and then your spouse will be on traditional, for example, based on how many years of service you had. Can the spouse continue under retiree medical if I'm forced to change to Medicare? Yes, that's the whole point of this this slide. If you are on the Medicare Advantage plan, a Boeing plan, then your spouse can be on the early retiree medical. Explain again how bond rates makes a difference to retirement distribution. So the high quality corporate bond rates are used to make the interest rates that are used to discount future pension checks back to today. Three rates published by the IRS are used to discount future pension checks back today. And they're made with high quality, they're made with the Treasury Department analyzing high quality corporate bond yield curve spot rates. If you have vacation time, is it better to take vacation or take a lump sum? Well, that depends. It's always kind of best to fill out. Let's pretend today is the day you want to quit today on December 3rd. Well, of course, that's a bad day to quit because you'd miss the holiday pay. So you'd use vacation to fill out like the rest, I guess. But whether or not you want to use vacation to spill over into the next month, you probably don't, because you would lose a month of pension check. So it's the same money, you would just lose a pension check. So you probably do want to burn vacation to fill out your last month, but you probably don't want to burn vacation to go into another month. If engineer from 89 to 2012, then management until 2020, then back at engineering, do I still get the pre-93 formula? Yeah, it all based on, were you a Boeing employee on January 1, 93? Based on what you typed, you were a Boeing employee. And so your BCERP benefit would use the pre-93 formula, the old alternate formula. Is the Medicare supplement only available to Medicare Advantage and not available traditional Medicare? Yes, it is only a Medicare Advantage plan now. The old Medicare supplement is no longer an option. Is there any issue taking 5 weeks of vacation just before retirement? Well, first, your vacation has to be approved by management, so they can say no. That could be an issue. Secondly, if you burn 5 weeks of vacation, you will have burned into another month, because there's no months that has less than 5. No months have, they all have less than 5 weeks in a month. So you would burn into another month, which means you would lose 1 month of pension checks, a pension check then. How much will the Aetna Medicare Advantage plan cost if I'm eligible for Medicare A and B? It's free. You don't sign up for the Medicare Advantage plan through Boeing is free, zero premium. You do have to sign up for Medicare A and B, and you have to pay for Medicare Part B. So Medicare Part B does have premiums, but the Medicare Advantage plan does not cost. It's free. It's free. Can you select a benefit commencement date later than termination date? And if so, what situations would make that beneficial? Better segment rates, EIPs. So yes, you can select a benefit commencement date later than your termination date. You must select a commencement date later than your termination date. You cannot commence while you're still an employee. So your termination date must be before your benefit commencement date. Perhaps you're asking, can I delay it for 2 or 3 or 4 or 5 months? If you're under 65, yes, you can. You can delay it as long as you'd like. However, keep in mind, every spring that you go past, every spring that you burn through while you're delaying, you do get a little bit older. So the age-based penalty will go away a little bit. However, the EIPs also will fall off. So if you delay, this year it's not that big of a deal, because if you delay past February of 25, what's going to drop off? 0. No big deal, no harm, no foul. But if you were to delay past March of 2026, then this one would drop off, and that would reduce your final average earnings. If you're terminated as an employee, future EIPs will not grow your benefit at all. So you have to receive the EIP as an active employee for it to count. Most likely, this year might be a weird year because what's dropping off is a 0. So I guess you could, in theory, go a little bit longer without commencing your pension. But you can model this actually. What would happen to my pension if I waited 6 months or 10 months or 12 months or 14 months? And so I'd encourage you to play with it. And it should be pretty accurate, because it doesn't know what the next EIP is going to be. No one does at this point, but it does. It knows this one will drop off, and that would model that correctly. I'm 65 and I have 25 years of pension credit service and 31 years of total Boeing service. What happens if I'm converted to a non-SPIA job code next year and I retire in 2026? Does that affect my pension calculation? Not that much. So your final average earnings stops growing when you leave the unit. Your retiring medical would be very different if you were under 65. But if you and your spouse are both over 65, the Medicare Advantage plan available through SPIA is the exact same plan at the exact same rate as the Boeing non-union Medicare Advantage plan. So as long as you and your spouse are both over 65 and you don't have kids under 26, there's no impact to retiree medical, and a very, very minor impact on your pension. I would ask why. Are they forcing you to be a non-union? We should talk about that, because, yeah. Will the Boeing pension reduce your Social Security payments? No, it won't. No, it won't. How do you calculate the cost of Boeing Medicare Advantage to keep spouse and child for medical with? So the cost of the Boeing Medicare Advantage plan is 0. Maybe you meant Advantage Plus. So it would depend. So again, retiree medical. Wrong one. Yeah. So if you are on these Boeing rates, for example, in this example here, right? I'm on traditional. It's me and a spouse, and it's what is that thing? Me and a spouse, 18 years of service. 18 times 3 1/3 is 60% paid by me, 40% paid by Boeing. I'm sorry, 60% paid by Boeing, 40% paid by me. And the rate now, next year's rate is almost the same, is $950.06 times 1, 2, or 3. It's times 1 for the employee, it's times another 1 for the spouse, and it's times another 1, so 3, for a child or children. So if I am on the Medicare Advantage plan because I'm over 65, but my spouse and my children are not, then it would simply be $950 times 2, 1 for the spouse and 1 for the child or children, times my contribution percentage based on my years of service. You should be able to model that also too. The lump sum calculation, why does this value not change if I put in age 55 versus age 57? It should. So if you are putting in two different ages and it gives you the same value, then it's not working. So if this person wants to email me PDFs of their estimates not changing for 2 years, yeah. Oh, still working and over age 73. Am I required to take RMDs and pay the taxes to the IRS? That's a difficult question. So for the 401k, no, you don't have RMDs while you're still working, period. But the pension, if you're over 73, then it's past the calendar year after you turn 70 and a half, which means you're receiving pension checks right now. And the pension plan will force benefits upon you April 1st, the calendar year after you turn 70 and a half. And you're receiving that money, and yes, you're paying taxes. But for the 401k, there's no RMD while you're still employed. Oh, good question. If you came back into SPIA from non-union, does your bonus count instead of EIP, or is it a factor of 0? It's a factor of 0. So only the EIP counts. The PBI does not count. The non-union have a similar bonus to our EIP, but theirs is called a performance-based incentive, and the PBI does not count for your final average earnings, only the EIP. Wow, I'm 65 this past August. How does my retirement medical coverage work with my 50-year-old wife and high school age kids? Exactly how we talked about before. When you retire, you have to go on the Boeing Medicare Advantage plan. Otherwise, your spouse and high school age kids will not have Boeing Medical. And I'm assuming you're asking the question because you want them to have Boeing Medical. So you would have to sign up for the Medicare A, Medicare B, and the Boeing Medicare Advantage plan. And then your spouse and high school age kids would get what you would have gotten based on your years of company service. I'm assuming the 3 1/3 would apply. Lots of repeat questions. Lots of repeat questions. Again, I'm retired. I'm turning 65 in 2025. Is the only way for my spouse. I think there's an issue. There's a bug in this thing. If Boeing goes through bankruptcy, restructuring is given that Boeing's obligation to the pension plan will stop and the PBGC payout guarantee must apply. Is it a given? No, it's never a given. It's never a given. It's possible that the bankruptcy judge would say, no, Boeing, your pension's fully funded, you keep it, your responsibility. So it's based on the bankruptcy, how it actually works. If Medicare makes changes, will our Aetna Medicare Advantage change? So this is, unless there are material Medicare Advantage funding, legislative, regulatory, CMS enforcement actions, or enrollment changes, this new plan will be offered in the form presented to SPIA with 0 premium. So you'll have to wait and see. Good question. Is the Medicare Advantage plan that Boeing provides retirees transportable to all 50 states? Yes, it is. The Medicare Advantage plan service area is the nation, the whole nation. So yeah, someone commented, I did roll over my Boeing 401k Roth to a Roth IRA with Fidelity help on the line, and they're 65 years old, over 59 and a half, so you can do that. Can you change medical plans after you retire from a tree? Yeah, so good question. Yeah, when you retire, if you're on the early retiree medical, you're going to get open enrollment every single year, just like you did when you were an active employee. So you can go back and forth between the plans. Please explain how to use retiree medical as expats in another country. All right, now we're getting the good stuff. I'm going to bcbsil.com/Boeing. And I'm going to say, no, I don't want to answer your question. Yeah, welcome Boeing, all right, Boeing. Doctor or pharmacy, international travel, Blue Card worldwide, search for providers, So you can find in-network providers in large cities nationwide, I'm sorry, internationally. However, the traditional medical plan and the Advantage Plus plan have worldwide coverage. And so if you end up finding somebody who's in network, then you're just going to pay your deductible and they're going to coordinate stuff and they'll do it in the currency exchange and that kind of stuff. If you find a doctor who's not in network, and then you're going to have to pay them the money, you're going to front the money, get a receipt, get a detailed receipt, get a detailed receipt, and then submit that detailed receipt, and they will apply it to your deductible and reimburse you. They have historical conversion factors based on all kinds of stuff. Just keep in mind, though, we're going to go to coverage, medical. We're going to look at active because it's the same. Traditional medical plan, SPIA. So here's the medical plan for traditional for SPIA. If you visit a healthcare provider's office or clinic for preventive care for non-network, it's not covered. So only for illnesses will it be covered in a foreign country. I heard you say working part-time affects retirement medical, but what if it affects active medical, not retirement medical? But what if a spouse works and if the spouse is eligible for benefits? I'm assuming the spouse works at Boeing. If your spouse is eligible for benefits, so if you're working part-time and your spouse is working full-time, you probably want to be on your spouse's benefit as dependent, and you can do that. If you're both working full-time, then you both have to be on your own. If you're both retired, you both have to be on your own if you have it. So the way that these questions and answers work is it's got to be a complete question. You can't do follow-on questions because I get the question one at a time and answer it, and then click off of it. Oh, so if we choose the Boeing Aetna Medicare Advantage plan, we sign up on the Boeing Aetna website? No, you go through WorkLife still. So you go through WorkLife. For a proposed termination on a holiday, is the holiday date? Yes, the holiday pay would be paid on your termination date. That's your last day as an employee. And so, yeah, you could terminate 12/31/2024 and commence your pension January 1, 2025. And you would get paid. You would miss the New Year's Day holiday pay, but you would get holiday pay for the rest of it. So my wife is 11 years younger than me. I'm 66 years old. I can be covered on employee insurance when I retire. I'm assuming retiree insurance. She plans to work until 58, so I don't know how many years that is, but more. Can I sign her up for the Advantage plan at age 69? Oh, so yeah, yes, so yes, you can. If you are working, if you're covered through your active employer's medical plan as an employee or as a spouse or on your spouse's plan, you can delay your enrollment in retiree medical. So you can, your spouse is working, your spouse has health insurance, not at Boeing, right? So let's pretend you work at Boeing, your spouse works at wherever, Evergreen Hospital. So you can be over, you're 66, you retire, you can be a dependent on your spouse's active employer-based coverage at Evergreen Healthcare, Evergreen Hospital. And then when your spouse retires, then you can pick up what you could have had, assuming nothing has changed between now and then. So yes, yes, you can both enroll that at that time when you lose your group coverage. There's a time limit, so do not delay. Do I need to work for Boeing all at the time of retirement, 55, to collect pension, or can I change job to contracting and collect pension at 55? If you're not a Boeing employee, if you're going to voluntarily quit Boeing before 55, then you're going to lose all kinds of benefits. Potentially, you're asking if I'm going to get laid off, can I be a contractor? If you're getting laid off at 49, then yeah, you could be a contractor for 6 years during that 6-year bridge and make it to 55. But if you're going to voluntarily quit Boeing and be a contractor, then no, you're not a Boeing employee. Oh, good question. For the retiree medical, does Boeing provide an HSA supplement? No, Boeing does not give HSA contributions to retirees, only active employees. Does Boeing match the 401k for vacation and sick leave payout? No, they do not. 66 years old with wife missing info. I have 30 with wife missing info. 66 years old with 11-year younger wife. I have 30. So I don't understand that question. So hired as a non-union professional in 78, then Boeing changed my job definition to SPIA in 2004. Were you a Boeing employee on January 1, 1993? Yes. It's got nothing to do with being in SPIA or not in SPIA. However, because you were non-union on December 31st, 1998, a lot of your old service got converted to a heritage PPP. So your B-cert benefit is way smaller than it would have been had you stayed in SPIA the whole time, or had you been in SPIA the whole time. But yeah, for your B-cert benefit, it would still. So the follow-up question on burning vacation versus taking a cash lump sum. Yes, you do get the company match. Burning vacation makes eligible pay for the 401k, so you can be matched. To get non-matching, get that. But we're talking what, 75% of 8% of your base pay versus a whole pension check that you might lose if you go into another month. So most likely you do want to burn vacation to fill your last month, but most likely you don't want to burn vacation to burn into the next month, because if you retire today, you're going to die, whatever, 35 years from now. If you retire 1 month away, you're still going to die 34 years and 11 months from now. You've lost a pension check. I got a bunch of thank yous. Thank you. Yeah, thank you. Sorry about that again, the cold. So I run a pension estimate for age 59 and a half and age 60, and I don't see a 3% difference in monthly payment. It is much smaller. Why? Why don't you send me both of those estimates, PDFs of the detail, and we can walk through exactly why. So there's a way to get the pension estimate detail. And if you send me the 59 and a half version and the age 60 version, we can identify and isolate exactly why it's less or not. Does the Medicare Advantage plan work outside the United States? No, it does not. None of the Medicare Advantage plans do. Non-Boeing spouse wants to work and they have dependent kids, helping to keep the Boeing plan for all, yet non-Boeing spouse is eligible for benefits through their employer. How does this affect the rates of pay? Would we pay more for the Boeing benefits or keep the listed formula? So we're going to go to the contract real quick. Article 16, medical benefits. So when you're an active employee, you pay an extra $100. If your spouse is working, eligible for medical at their employment, and waives it, you pay an extra $100 a month. Yep. Same thing applies if you're retired. So if your spouse is working, eligible for benefits where they work, and declines those benefits where they work, and is covered by Boeing, you're going to pay whatever that formula said plus $100 a month. One way around this, your spouse doesn't. Maybe your spouse has multiple options at work. She could just choose the cheapest plan. She doesn't have to choose the best plan. Maybe she pays $50 a month to get her plan just for her, and then then she didn't decline her plan. But yeah, if they're going to decline it 100% and be on the Boeing coverage, it's an extra $100 a month, which actually is still an awesome deal. If I choose Advantage Plus for my early retirement medical, does Boeing provide an HSA contribution, and can I still make my own contributions? That's a two-part question. The first part is no, Boeing does not make HSA contributions to retirees. But the second one is yes, you can. The rules about, and again, you can figure this out, HSAs are universal nationwide. HSA contributions do not have to be earned income, just income. So the one example here for this exact same this is me and a spouse, 18 years of service, 60% paid by Boeing, 40% paid by me. The rate for traditional is $950. The rate for Advantage Plus is only $860. It's less. And so since it's less, I'm going to save money. I'm paying only 40% of it. So I'm going to save what, $900 a year. I can put that into my HSA if I had income offsetting. So technically you could tax shelter a pension check or 2 or 3 or 4 and put that into your HSA. You can still make contributions as long as you're still an HSA qualified individual, which means you're not on a non-high deductible health plan. Okay, people are saying, yeah, you're welcome. If a non-Boeing spouse is working and I'm retired, at first she has her own employer benefits. Can she later retire and I add her to my plan of retirement? Yes. If your spouse is working and you do decline to enroll them because they're covered by their employer, you can add them when they lose their employer-sponsored benefits. And I've done it. We had more questions than I thought, but thank you very much. I've gone through them all. If for some reason, there were a couple questions that were like repeated quite a few times. So I don't know if that was a glitch in the system or what was going on, but if for some reason I clicked too quick and I deleted your question, just feel free to email me, mattk@spa.org, and I'll do my best to respond as quick as I can. All right. Yeah, thank you. Have a good night. And this will be online tomorrow, hopefully before noon. All right, good night, everyone.